Hi, I'm Eric Kazatsky, Head of Municipal Strategy here at Bloomberg Intelligence.
And I'm Karen Altamirano, Senior BI Associate with Municipal Strategy.
And welcome to our latest video looking at what's going on in the muni market. Obviously, if you've been paying attention to the rates market in general, there's one story that's obviously dominated headlines and chat rooms alike, and that's really been the rise in treasury rates over the last week and a half. Pretty significant move, I think, that caught a lot of people by surprise, even though the Fed has basically said that they're on hold right now. That has obviously bled into the muni market, though to a lesser degree. I know Karen's been paying attention to what's going on from a rate standpoint, so what are you seeing?
Yeah, so we've seen sell-off. The sell-off pushed September AAA yields up by more than 50 basis points across the curve. And now to start off October, what we've seen is some smaller cuts. And then moving down the credit stack to our BVAL single A revenue curve,
Mhm.
what we've seen is yields also move up about 60 basis points. But that's been more on the front end, on the back end, not as a smooth movement like we've seen with
Oh,
AAA.
that is interesting. You know, something else that we're paying attention to has obviously been the impact to total returns. And coming into September, we were pretty pleased to see that munis were up year to date and outperforming like we had anticipated they would do in a Fed tightening cycle. Obviously, the last month has sort of flipped the script on muni returns, and they're decidedly negative. Just to give some context and some numbers around it, over the last month and a half, munis have lost about 3.4%, and their returns are obviously down pretty solidly, about 1.8% for the year. Unfortunately, I don't think we're seeing much of a positive tailwind coming into the sector over the month of October. We did put out our October index monthly sort of prognostication, and on a historical basis, October really hasn't been the strongest month from a performance standpoint. And we're kind of thinking that best case scenario is we sort of chop along right now over the next 30 days. So sort of crossing our fingers and hoping that that comes true and rates don't continue to tick higher. What we are trying to do is sort of sift through this rubble right now and trying to find some positive things to talk to clients about and not sort of hang our hats on being completely negative about the market right now. And one of the things that Karen and I have sort of fleshed out is that there's been some changes in market structure that I think are actually helping the market right now and could actually help us a little bit more going forward.
All right, so one of the good things that we can point to is the market composition has shifted for the better and is providing buyers with some defensibility. This is reflected both when you look at the muni market from an issuance and an outstanding standpoint. When rates were close to zero, up until 2022, there was desire from buyers and issuers to drift towards lower coupon
Hmm.
structures, and this is something we highlighted this week in our
Yeah.
research, where we compared the 2017 tax equivalent issuance composition to 2021. So let's take a look at how that composition stands today. Here we see that previous trend has reversed. In 2021, a premium coupon issuance, bonds being issued between 5 and 6% coupon buckets reached a low of 30% of total tax-exempt issuance. And year-to-date issuance in 2023 now makes up more than 60% of total exempt issuance. So that's a positive for the market and should help provide some defense for investors.
Yeah, I mean, absolutely. And it goes to sort of how our outlook was for the year, that we thought there was going to be some trouble brewing with sort of the prevalence of these lower coupon structures in the market if we had a backup in rates, which indeed we did. The second thing that we're sort of looking at that could be a potential positive for clients to sort of think about and talk about with their clients is the fact that there's been such a significant move in rates that a lot of the sting has almost been taken out of the market right now, and it could be one of the reasons why the latest sell-off has felt, for lack of a better word, a little bit orderly. If we look at how much of the Muni index, LMBITR, is actually pricing at a discount right now, it's almost the entirety of the coupon stacks from 4% and below. And what that really means at the end of the day is that for a lot of these low coupon structures, duration is basically extended to the maximum it can. Now, obviously, there could be further price declines if rates continue to tick higher, but from a duration extension standpoint, at least that's sort of one risk bucket that's sort of been taken off the table and could be a potential positive in all of this. So, again, trying to find some silver linings in all of the mess going on right now and hope that there's some good takeaways that you can share with the people that you talk to. Again, talk to you next time, and thanks for joining us.